Bed Bath & Beyond is preparing to file for bankruptcy. The FDIC finally announced how much money they lost after the Silicon Valley Bank collapse, and Disney announced that they're going to be doing more layoffs. Let me start by talking about what's going on with Bed Bath & Beyond, because there's some very interesting information here that I really want you to understand, especially with how they manage their money. So according to Wall Street Journal, let me read you what they said directly. Bed Bath & Beyond is preparing a bankruptcy filing for as early as this weekend, as its failing stock price makes it near impossible to raise enough capital to avoid default. In other words, Bed Bath & Beyond cannot raise enough money to stay in business, so now they are preparing for a Chapter 11 bankruptcy. The part that I want you to really understand here is why they're going to be declaring bankruptcy. Now, the first reason has to do with the actual way that they run their business. They didn't get on the internet fast enough. They weren't able to adapt to the changing times. And so their sales were falling and their profits were falling and their costs were rising, which is a big reason. But the second reason why has to do with the way that they manage their finances, which isn't just a Bed Bath & Beyond issue. This is something that I have been talking about a lot, and you're seeing this happen across many different companies, across many different industries. In 2021, Bed Bath & Beyond, like many other companies, raised a lot of debt. And what did they do with their money in 2021? Bed Bath & Beyond didn't use this money to go out and invest in more stores or invest in new infrastructure or invest in new technologies or invest in the e-commerce store. In 2021, Bed Bath & Beyond did a $625 million stock buyback. Why? Because it was a way for them to enrich their shareholders in the short term. And this is something that we've been seeing happen, not just with Bed Bath & Beyond, but with a lot of companies over the last few years, where we've been seeing a lot of stock buybacks happen. Now, there's nothing wrong with stock buybacks to do them the right way. There's a time and place for stock buybacks. But the reason why I'm bringing this up is because in 2021, we saw a record amount of stock buybacks. In 2022, we saw a record amount of stock buybacks. And in 2023, well, right now, we are currently still on pace for a record amount of stock buybacks. And the reason why this is interesting is because, well, a stock buyback is when a company takes their profit or their extra cash that they have laying around, and instead of taking this money and going out and investing it back into the company, they use this money to reward their shareholders by buying up their stock to make the stock price go up, to make their company more valuable, aka to make the share price more valuable. Now again, there's a time and place for this. If you're a company that has healthy profits, that has extra cash, sure, use some of the cash to enrich your shareholders because your shareholders have been investing in the company. But what we have been seeing happen over the last few years, and we talked about this a lot in market briefs, is over the last few years, we've been seeing a lot of what's called leveraged stock buybacks. Leveraged stock buybacks, which means companies make some money, and then if they made $100 million, they go out and borrow another $400 million from the bank. That way they can do a $500 million stock buyback. They had $100 million with the cash. They borrow $400 million because interest rates have been very cheap. That way they can go out and do a $500 million stock buyback. That way they can boost the stock price even more. Now again, what does that mean? That means a company is going to have to use their future earnings to pay back their debt. Because when you go out and do a stock buyback, that is not an income producing asset. Like if I used my money, if I went into debt to go out and buy a rental property, that's an income producing asset. I went into debt to buy a property that's paying me with cash flow. My cash flow from the rental property should pay back the debt if I do it right. Or I can use debt to go out and buy a business. Again, it's an income producing asset. If I raise $1 million to go out and buy a business and the business can pay off the debt, it's an income producing asset. But when a company goes into debt to buy back their own stock, that's not an income producing asset. You're going into debt, increasing your expenses to buy something that isn't producing an income. It's like going into debt to buy a new Gucci belt. It's buying a liability. It doesn't produce any income. And that was one of the final straws for Bed Bath & Beyond financially, because in 2021, they spent $625 million on a stock buyback, which was money that they couldn't afford to lose, which in the short term enriched the shareholders and made the stock price go up. But in the long term, now that was more expenses for them to pay, and it was cash that they no longer have in order to continue investing back into the company, which is why if you want to understand what's happening, keep up what's happening, you should subscribe to something like Market Briefs, which is my free financial newsletter that keeps you up to date on what's happening in the financial markets. When it's happening, it's completely free. You can read it in less than 5 minutes every morning, and we keep you up to date with what's happening in the stock market, the housing market, the global economy, our own economy, and inflation. So if you haven't joined Market Briefs yet, it's a fun and easy to read email, and you can join for free down in the description below. This brings me to the topic of the FDIC. Now, we all know what happened with Silicon Valley Bank, where Silicon Valley Bank collapsed. Then when Silicon Valley Bank collapsed, many people were worried because FDIC insurance protects your deposits up to $250,000. And in the Silicon Valley Bank case, you had a lot of people who had way more than $250,000 in the bank. In fact, Silicon Valley Bank was a huge exception because the bulk of their depositors had more than $250,000 in the bank, because a lot of their depositors were the startup tech type companies who had millions of dollars sitting in the bank. And so when the bank failed, if you had an account with, say, $10 million in there, you were only protected up to $250,000 with FDIC. And this was a big concern because now all these startup companies said, oh my God, we had tens of millions of dollars in the bank. We have no money left to pay payroll next week. How are we supposed to pay rent? How are we supposed to pay our employees? Because now our money's all gone. It just disappeared. And that was when you had this emergency meeting with the FDIC insurance. You had the Federal Reserve, you had the Treasury Secretary come together, which essentially said that they were going to protect depositors up until infinity. And then, of course, after Silicon Valley Bank, we also saw Signature Bank fail. And again, they extended this deposit insurance for depositors up until infinity, even though FDIC insurance only protects you up to $250,000. So that happened. Well, FDIC insurance doesn't have enough money to protect all depositors, let alone deposits up to infinity. And so how does FDIC get their money? Well, FDIC insurance is backed by the full faith and credit of the United States government, meaning if a bank fails and they have to then enact FDIC, then FDIC would then go out and give money back to the depositors. And if FDIC runs out of money, they can go to the United States government, because the FDIC is backed by the full faith and credit of the United States government, who will then pay the FDIC, which begs the next question. Where does the United States government get this money? Well, the United States government has one source of income: you and me, taxpayers, through tax dollars. The government has no other streams of income. The only problem with that is the government doesn't make enough money to cover their expenses as it is. That's why the United States government has a very large annual deficit, meaning they spend trillions of dollars more than what they bring in every year. And that's why we have a almost $32 trillion national debt, because the government has spent so much more money than they brought in. So if the government doesn't have enough money, then where do they get that money? Well, then they work with the Federal Reserve Bank to print that money, give it to the United States government. The government gives it to FDIC. The FDIC gives it to depositors. And then who pays the price? Well, everybody, in the form of inflation, because if the Federal Reserve Bank prints money, you increase the amount of dollars out there, the value of each individual dollar goes down. That's what inflation is. Now, this particular situation with Silicon Valley Bank was slightly different, because when FDIC was expanded to infinity, what the government announced was that FDIC would pay for this money by providing or charging a special assessment on the other banks, aka they were going to charge a fee or a fine or whatever you want to call it to the other banks. That way FDIC has more money to pay back their depositors. And now we finally got some information. Wall Street Journal published an article on this just recently about the FDIC, their deposits, and how much money they lost. And what they said is, this is directly from Wall Street Journal, the FDIC estimates that its deposit insurance fund will lose about $22.5 billion from depositor payouts, meaning that amongst the most recent bank collapses, FDIC is going to have to pay out about $22.5 trillion. And going deeper, where it gets interesting, is that about 19.2 billion, so almost all of it, 19.2 billion of the losses came from payments on accounts that exceeded the standard $250,000 limit on FDIC insurance. Now, the reason why that's so significant is because if FDIC insurance wasn't expanded, that means FDIC would have only had to pay out about $3.3 billion. But because FDIC insurance was expanded beyond the $250,000 limit, instead of paying $3.3 billion, they have to pay out $22.5 billion, meaning a lot more money than what was originally expected. And going back to now the Wall Street Journal article, it says that the larger deposits were only covered after the United States designated Silicon Valley Bank and Signature Bank as a systemic risk. So the only reason why FDIC covered this additional money was because they call it a systemic risk, according to the FDIC, the Federal Reserve Bank, and Treasury Department, because if they did not bail out the depositors, that it would have caused contagion in the banking sector and more bank runs and a lot of pain in the banking sector, which is why they covered it. Now, it's still unclear exactly how much money they're getting from other banks, how much money FDIC is going to be getting from the government. There's still a lot of gray area here, because let me read you directly from what Wall Street Journal said. It said, most of the money that the FDIC has to pay out will be reimbursed through an assessment on other banks. How much? Most of that money. How much is most? Well, I have no idea. This is just what the information that we have. And so this is where now understanding that if it's from an assessment on other banks, then sure, it's not coming from taxpayers, it's coming from bank users. Who's a bank user? Well, if you bank at Bank of America, if you bank at Chase, if you bank at PNC, you're a bank user. And these banks now have to pay an additional assessment, meaning a fine, which means that they're going to have higher costs, which means that they're probably going to have to now offset these costs through other fees. Who's going to pay for these fees? Well, the customers at these banks. So there's always going to be a cost. The question is who pays the cost? Either it's going to be the taxpayer or it's going to be the customer. And well, people are both taxpayers and customers because everybody needs a bank and everybody has to pay taxes. Now, how much is not paid by the banks? Well, we don't know. It says that most of it will be reimbursed through other banks, which means that all of it is not. Some of it is going to have to be paid for by the government, which means some of it will have to be paid for by tax dollars. And the exact numbers are still coming through, but now we at least know that about $22.5 billion is going to be paid out by the FDIC insurance for the lost money for these banks. And this brings me to the topic of Disney, which is kind of an interesting one, because Disney has been an interesting thing where, one, Bob Iger, the previous CEO, has come back to help turn around the company. And now to turn the company around, they're doing what many other companies have been doing, which is cutting costs. And Disney just announced that they're going to be laying off about 7,000 workers starting next week as a way to increase efficiency, meaning cut their costs, and hopefully increase productivity from each worker, meaning each worker is going to have to do more work. And a big thing in this is also the streaming platforms that they have at Disney, that they're going to be working extensively to turn some of their streaming platforms around, make a bigger profit from the streaming platforms because they've been bleeding a lot of cash from these streaming platforms. But I think the big point here isn't just what Disney's doing, but what this means for the broader economy, because we've been seeing kind of the same story in a lot of different places where companies are saying, okay, our revenues are not growing fast enough. Our expenses are rising. Our expenses are rising because, for one, inflation. Our expenses are rising because, two, our debt costs, our debt servicing costs are rising because a lot of corporate debt is not fixed rate debt. It readjusts every few years. And so now as interest rates are higher, the costs for these businesses are higher. And three, we just have to buy more things because of business costs. So now businesses are looking for ways to tighten up, especially because money is getting tighter, interest rates are higher, inflation is still high. So this is something you want to pay attention to, because it's not just Disney, it's not just Bed Bath & Beyond. You're seeing it happen in a lot of different places, and this is where you want to be financially savvy, you want to be smart and not panic, but prepare, because the reality is the craziness is not going away anytime soon. It's going to continue, and this is where, if you're understanding what's happening and you're preparing, meaning you're building your financial education and you're putting that extra money aside that way you can take advantage of opportunities, you will be able to find opportunities. But you have to prepare and you have to build that financial education. And of course, we work to keep you updated every day on market briefs, which is why if you haven't joined yet, make sure you do so.